Thank you very much for taking time out to join this session. The session is around digital lending, especially how does it really transform credit in a way. The way I'm going to take this session is I'm going to talk about three things. One is really around BNPL, which is buy now, pay later. I'm sure y'all would have heard about a lot of disruption and new offerings that's taking place. So that's going to be one. The second one is really going to be around asset-based lending, and all traditional models, at least till now, have been around asset-based lending. But that's a space which is also transforming quite rapidly. The third one is going to be around cash flow-based lending. And this primarily has picked up a lot of steam because traditionally, there are a lot of people who do not get covered by formal credit, because they maybe don't have a credit history, or what is classically called is they are thin file customers. They're not thick file customers, which means that they do not have any formal credit history. But increasingly, I think digital and data is helping financial institutions to really arrive at some kind of an assessment on whether they're credit worthy and whether it's really taking the risk. So these are the three things we'll speak about. Obviously, I'll speak about a lot of examples. I have some sample journeys that I'm going to talk about. Obviously, those are illustrations from the work that we've done in the region and as EY. So broadly, that's what we're going to cover. Let's straight away dive into the first one, which is around BNPL, which is called the buy now, pay later. So there are two broad kinds of BNPL offerings that we have. One is around convenience and the other is around credit, right? And when we're talking of convenience, till now, typically if you swipe a credit card or you use a credit card in an online journey while you're shopping online, right, is what you use. You typically get anywhere between 30 to 45 days to pay off the spend that you have. If you don't pay, then obviously you're charged a very hefty interest per month as well as a late fee, right? That's part of the credit card experience that's typically seen. Now, a lot of fintechs, are trying to really disrupt this this journey, right? Because now when you're checking out, right? I mean, if you were to just look at an online journey, right, or even look at an offline journey, you go to a store, you have to swipe the card, or an online journey, you have to remember the card number. You have to give. Typically, they would ask you for the CVV number, the expiry date on the card. A lot of places they send an OTP as well that you need to fill in, right? So you typically need the card with you. Now, the thought behind the disruption that's happening when you're looking at convenience as a BNPL product is saying that at checkout, there should be no experience on payment. It should be seamless, right? So you shouldn't be asked for a card number, a CVV, an expiry date, or an OTP, or any of those things, right? And that's something that's picking up very, very quickly. And you would have seen that, if it's a cab aggregator like an Uber, or any of the ones that are prevalent in the Middle East, if you link it to a particular app or wallet, the payment is seamless. Right. While if it's a wallet, it's a prepaid wallet, you have some money in it, but there are models where, if you just linked it to a particular app, you don't need to have it as a prepaid wallet. It gets paid, and then you pay that company after 15 days or 30 days. Obviously, if you don't pay, there is a late fees that is involved as well, but it's not like you're paying a hefty 3-4% a month kind of an interest rate as a late fee. Right. So that's really that model around convenience, right? And I just took an example of a travel aggregator like an Uber. But imagine if it's a food aggregator where you're ordering food online and you don't want to pay while on a checkout, and you want to, it just seems automatic and seamless, right? Or you're booking airline tickets, or you're shopping online, you're buying grocery, or even ed tech now, education, especially online education, where you want to subscribe for courses, and you don't really need to have the pain of paying for every time you subscribe for something. You just want to pay an aggregate amount at the end of the month or at the end of 15 days. So that's really around convenience. And this view that I told you about is just from a consumer standpoint, right? People like you and me who are spending and not wanting to really go through a journey which has a lot of friction around remembering stuff. So the examples that I told you are all frictionless. You linked it to a particular BNPL service provider, and the payment happens automatically. Similarly, what's happening on the merchant side, right, or on the SME side as well, and I'm just talking about the convenience product, is that typically with credit card networks, right, there is a fee that they have to pay, right, and that is something that is also trying to be disrupted, um, where the fees are much lower for the SMEs, and these BNPL providers at the same time are also providing credit to these SMEs, small shop owners, right, because they get a view of the kind of spends that are happening and the kind of business that they're doing by month, by quarter, by the year, right? So that's really around convenience. The other revenue model obviously is the subvention fees. So a lot of these BNPL providers have a tie-up with the merchants, either online or offline, and they have a subvention fee model, which is a percentage of the spend that they have done, but it is much lower than the MDR charges that a typical network would charge. So that's really on the convenience side. Obviously, that small ticket sizes, in terms of spends that are done. The second product on buy now, pay later is really credit, and which is the classic case of, say, for example, you want to buy a consumer durable good, may it be a television, a refrigerator, or a mobile phone, right, or a laptop or an iPad, right? And you want to pay in installments, may it be 3, 6, 9, 12 months, or at times it could be 24 months as well, right? In this case is typically compared to a convenience product, the ticket sizes are larger. Obviously, the BNPL providers are targeting new to credit customers, which means that customers which do not have a credit history, and there is an assessment done in the online journey itself in a matter of 3 to 5 minutes, where they decide whether they want to give a loan to a particular consumer. And if yes, then how much? If no, obviously, then it is declined. And we'll talk about some of these examples as well, where, how does it happen in an online journey? What are the key things that you have to keep in mind while really looking at this? And the revenue model obviously is around subvention and interest. So there is a subvention fee model. So wherever the BNPL provider has tied up with a merchant, whether offline or online, there is a subvention fee, and then there is an interest that you charge to the customer, right? Depending on the tenor of the loan. So to summarize, BNPL service providers, convenience is one end, and the credit is the other. We'll look at some examples now, just to bring this to light. Right. So this is an illustration, and we'd worked with this customer, where the product that was being offered was a digital lending product. It was a personal loan, basically. And this had to be disbursed in 3 minutes. So this was not a bank, which meant that they could not have any existing account. So for example, if I wanted a personal loan, I would just download this app, right? And we'll walk through the journey. And I need not have an account with this particular financial institution because it was not a bank. It was a non-banking financial institution, right? So they could not take any kind of deposits. It was only into lending. Right, and here now I'll just quickly run through the journey and talk about some of the nuances. If you look at this, this product was called Dhani. I'm talking about. So this was the, once you've downloaded the app, this was the home screen. It would validate your mobile number, which would mean that they would ask for a mobile number, and basis that number, it would send you an OTP, which is a one-time password that you would fill in for mobile validation, just to ensure that the mobile that you've downloaded on and the number that you're giving is in sync. Then simple things it would ask in terms of the loan requirement, in terms of the value, the tenor, etc. Post that, it would do your KYC, which is know your customer. All right, and because this is an example from India, where we have Aadhaar, which is a national identity number that has been given. The KYC would be done basis the Aadhaar. So it would ask for an Aadhaar number, which it would, once you've given that number, what it does is Aadhaar is linked to a mobile, right? And because of that mobile, it'll send that OTP on that mobile link to Aadhaar and validate whether this in step number 5 is the same in step number 2. So once you establish the KYC or know your customer, which is a very important step to establish identity of who is looking for a loan, and there's a lot of regulatory oversight around this as well for all financial institutions across the globe, because there's a lot of checks that happen in the background around fraud and around terror funding as well. This is a very important step in any country that you go to, where you need to establish the credentials of the individual or the company you are lending to. Once that is established, obviously ask for some bits of personal info, and then basis that, what is happening in the background is it's done a fraud check on you. It goes and checks whether you really have a credit history. Right, if it has a credit history, it'll go and check the bureau as well, right? So there's a credit bureau, that'll give you a score, whether that score is above a particular threshold or below a threshold, right? It will also see your address, right? So the rule engine is working in the background to really establish whether there are any fraudulent cases against you, and second is obviously whether you have a credit history. If yes, then are you worthy of giving credit? If you don't have a credit history, then it looks at alternate sources of data, right? And that is where institutions are looking at lending to new to credit customers, or you call as NTC customers, which is new to credit customers, right? And they look at your social graph with consent. If you allow them, they may want to scan your SMS messages as well, right? They would want to look at the kind of education you've had, where have you had your education, where are you staying, and they create a social profile. Basis that social profile, they will decide whether they want to lend to you or no, right? This is done provided you do not have credit history, right? Once all of that is done, they give you a soft sanction, right? Saying that you are eligible for, say, $1,000, $2,000, $5,000 that needs to be paid across, say, 24 months or 36 months. And this is going to be your EMI amount. So this pretty much is your loan sanction. Now, beyond loan sanction to disbursement, which is beyond 10 and up to 14, there are checks that they will do, right? So one they will do is they'll obviously want a selfie. What they do with the selfie is that you take a selfie on your phone. They then verify it with your national identity that you've given, which is Aadhaar. All of this happens in the background. The customer doesn't know about it, right? And it checks whether it's the selfie that you've taken and the identification that you've given matches, right? Because at times somebody's phone is stolen and somebody else is doing it, right? So you want to avoid those kind of scenarios. So this is what happens. So it checks this along with what is given as a national identity. The second is e-sign, where it asks you to sign a document, right? Because at the end of it, it's a loan. So you need to have some kind of a loan document that the customer needs to sign, right? So this also happens in the digital journey, right? So here you see the screen where you think accept for e-sign and sign it, and it is recorded, right? Post the e-sign, the 13th step is around the mandate registration, right? So where are you going to be paying your EMI from, right? So you would say that, yeah, I have a bank account, please debit it from this particular bank account. The EMI amount is already known. So before the disbursal happens, if you see, I mean, there is a KYC done, there is a background fraud check and a rule that checks whether loans has to be sanctioned. If yes, what amount and for what tenor. It then checks your selfie. It asks you to sign a loan agreement. It sets up a mandate, right? Where are you going to be paying from? Once this is successful, right, then the amount is disbursed immediately into the account. Which account? The account from where the mandate registration has happened, right? So this is where the disbursement happens, right? Now, if you see this entire journey from step number 1 all the way to step number 14 was accomplished in 3 minutes, right? So all the way from once you open the home screen to disbursement, 3 minutes flat, right? Completely digital. Right, and this was the happy part. Obviously there would be other parts as well where people are not able to finish the journey. Say for example, they don't really have the identification, or they don't have a phone with a clear this thing where they can take a picture, right? Or they're not able to set up a mandate registration, right? In that case, which is the unhappy part, where the journey is stopped and the person who's applying drops off, then obviously we had call centers who would call them and prompt them to get back onto the digital journey. So when this product was launched, we typically saw that around 60 to 65% of the people managed to accomplish this straight-through processing. The balance 35% had a break in the journey, and they were contacted by the call centers to really help them finish the journey. Over a period of time, between 4 to 6 months, we saw that this 65% went up to close to 85 to 90%. All right, so around 85 to 90% of the people who downloaded the app were managed to really get a disbursement in less than 3 minutes. Right, so this is an illustration of a personal loan journey. Now you can go onto YouTube and also look at the video by the name of Dani. If you're following cricket, MS Dhoni used to be the former cricket captain of the Indian cricket team, is actually advertised for this as well. And I encourage you can look at this. So this was one journey, which was a personal loan journey, unsecured personal loan. So you see that there is no underlying asset that this company is really asking for. It's a personal loan. You could do whatever you want with this money, right? And that amount is disbursed in The second is a consumer durable lending journey, right? And this is an example of, and this was available both offline. In this case, you assume you walk into a store and want to, right, for somebody in the family. Now that phone, is expensive. Sorry, am I audible?
I can hear you now. I can hear you now, Mr. Alish. Please continue.
Yeah. So this was a consumer durable lending process where you walk into a store and then you want to look at financing options to buying the
sorry to interrupt. Are you showing slides?
Yes.
Yeah, the slide, if you can share it, please, it would be great.
Oh, just a minute. Sorry for that disruption. The screen is visible. It says consumer durable lending journey.
Yeah, I can see it from my side here.
Okay. So this a consumer durable lending journey, right? So in this, again, the journey is where you download the customer app either, and we had this on both iOS and Android. Again, similar thing where you input the mobile and the OTP. You do your KYC, right? And then in the background, it really looks at your score, see whether you have this thing, credit history. And then it assigns a credit limit. It again views your loan agreement, and then credit line is activated, right? Which means that here the payment does not really go to the individual. The payment goes to the merchant, right? And once the merchant receives the money, the merchant will hand over the phone to you because that's what you're buying, right? But if you look at the key steps in the journey, it's still the same. It establishes KYC. It looks at whether you have a credit history. If not, then again, as I told you, it looks at your social graph. With consent, it may scan through your SMS messages, right? Basis that will come up with a credit limit. And then you again sign a loan agreement, and then you activate the credit line. And you can decide to spend the entire credit line on one purchase, or you could buy multiple things, right? So if you're allocated $1,000, you may say that I want to spend $400 on a phone, $200 on a television, maybe $100 on a refrigerator, right? And that's how you use your credit line. You may even want, and obviously here what happens is that the lender in this case has a tie-up with merchants, right? Because there's a subvention fee that needs to be discussed and agreed, negotiated. And this was available in both formats, in the offline format and in the online format. So you could pretty much, walk into a store where they had a tie-up, buy the phone, and this was available. Or you could go onto an Amazon, or you could go to any of the other online providers and maybe buying a similar product. And once you bought it, you add it to your cart before you check out. You can say that you're looking at a financing option, right? And then obviously the lender would follow through with this journey. In this case, the difference between this example and the previous example was completely unsecured. It was just a personal loan. You could do whatever you want with the money. Here, it's a consumer durable that you're buying. So the loan is again some kind of a consumer durable that you're purchasing, right? And that's why that money really goes to the merchant, and then the merchant is handing over the goods to you. But some of those basic things continue to be the same, right? So this is the consumer durable journey. We'll move on. So typically the BNPL ones, if you see the travel aggregators, food aggregators, e-commerce, and offline stores, pretty much prevalent in this category throughout, from a BNPL standpoint, right? And we've seen EdTech as well, which is the latest one, especially for children or even for professionals who are looking at professional training and education. There's a huge amount of interest around BNPL providers tying up with these aggregators or these service providers and offering these services both from an offline aspect or an online aspect, and both from a convenience standpoint or from a credit standpoint. Okay, we'll now move to asset-based financing. And here again, I think this has been on for ages, right? You lend basis and asset. but and we'll again talk about an example here. In this case, it's going to be a car, right? You assume that you want to buy a car, and again, cars today are available in both formats. You could walk into a dealership, or you pretty much search online and buy online as well, right? And this is where the origination starts, right? The origination of this journey is not on the lender's platform. The origination of this journey is on a platform which is to compare cars and start from there, or walk into a dealership and you've already decided that you want to buy a car. So the first step is around deep integration with origination players, right? And what I mean by origination players, it could be OEMs or car manufacturers. It could be online websites which help you to compare various models of the cars, and need not be first-hand cars. It could be second-hand cars as well, or reselling cars, right? Used cars as well. But that is where the origination starts, and that is why for lending companies it's so important to deeply integrate with origination players in their journey. Because if I am looking to buy a car, I'm first going to be thinking about the car rather than thinking about where am I going to be taking the credit from, right? The second then is obviously analyzing alternate sources of data, very similar to what we spoke about at BNPL, where maybe you don't have credit history. Then they look at various aspects of your social graph and etc. to arrive at whether they will want to lend to you. If yes, then how much? And then again, other parts around contracting, repayments, and collections, right? All of this enabled digitally is also very, very important, right? And obviously, as the ticket sizes of lending get smaller, right, the amount that you spend on collections has to also be in that correlation, right? Because you will have customers who will take a loan and not pay, right? And you need to have a robust collection mechanism to ensure that you do not lose your money, right? And in a digital world, especially where you're enabling digital journeys, it's important that you look at the aspect of collections as well, right? So this is pretty much on the asset-based lending. We'll go next. I'll talk about the example here. And here again, it's, as I told you, you're looking at buying a vehicle, and with that, how will you really embed your lending particular thing? And obviously, there are 5 different steps to this journey. Obviously, we've also given the various things that are used, the various fintechs that are used, the various data points that are used in each of these. So each of these you will see is related to these 5 steps, right? And the first one, as I said, is the selection stage, where you dealership, DSA, branch, you select the vehicle, and then you look at the financing options. And this is an assisted journey, right? So what we are saying is that this is not an online journey. So it's actually somebody's walked into a dealership or a DSA or a branch, and then somebody in that dealership is helping you to avail the financing options, correct? And the things like the business executive will capture the customer details of the demographic, where do you stay, how long have you been staying, what is the underlying asset, right? And all of this is in the mobile app. So the dealer would have what you would call a mobile app where this is filled out. And then the customer provides certain documents to the business executive, right? What those documents are would primarily be around the KYC. And if you have a credit history, then some kind of an identifier to really say what is your credit score looking like. If you don't have a credit history, then what it would primarily do is look at alternate sources of data. Basic eligibility is verified. I mean, you look at the veracity of the underlying asset, especially the car, whether it's registered, what is the engine capacity, right? Is it a first owned or a pre-owned car, right? That database is, at least, and I'm talking about India, there's a database that's controlled by the government, which gives you that kind of data. If it's a pre-owned car, is there an existing loan running on that particular car as well, right? You could check that as well. If the individual is filing IT returns, then you could look at analyzing those returns all online, nothing in physical, right? So you're not handing over documents saying this is my IT return. It can pretty much, with consent, through API calls, look at your IT return, etc. It will verify your telephone, typically an OTP that is sent, and then you OTP into the app. And then pretty much in the background, within 2 to 3 minutes, your fraud check is done. The credentials, underlying asset is actually verified. Your income details is something that is analyzed, right? And then you're given the soft approval comes on the app itself to the dealer saying that this individual is eligible for this loan, right? So if it's a $10,000 car and you get a $6,000 thing, then obviously you tell the customer that 4,000 is what you'll have to pay, and the financing option that you're getting is $6,000. You'll have to pay in 24 months. This is the EMI that you have to pay per month. All of that, right? So all of that really is something that happens in this thing, right? And then post that, obviously, what you would do, and again, all of this is digital. There's no paper involved. Again, you'll sign the agreement, set up the mandate, right? And once all of that is done, the loan is disbursed into the dealer's account, right? And once the dealer gets the money, we'll hand over the car keys to you to take it over, right? And then if there are any servicing options, typically if you miss a EMI payment, and you want to make that payment, then there are options available on the website or in the mobile, right, for paying and all of that. And then obviously, if you don't pay, then there is the whole recovery process for delinquent accounts, where a collection agency will really come and then look at collecting the money from you, right? But again, all of this is completely digital. It's a journey that happens in less than 15 minutes, 1-5. This is an assisted journey. Again, it's an illustration because here we've taken an example of somebody walking into a physical store to really decide the car model, and then that particular dealership helping this individual with this entire journey. Right? So this is again an example of an asset-based lending. Okay, I think we've already 30 minutes, 35 minutes into the presentation. We'll come to the last one, which is around cash flow-based lending, right? And there are multiple models that are really emerging. When you look at cash flow-based lending, I'll talk about, and here we don't have sample journeys, but I'm going to talk about 3 things. One is around point of sale and digital payments, right? So for example, today there are lending products that are available to SMEs, and assume that it's a small shop, right, which has a POS machine, right, and is typically accepting payments by swiping on the POS machine, which is a point of sale machine, or it is asking you to make digital payments, right? So basis the number of swipes and the amount that has been collected on the point of sale machine, you would typically know that, say you've done business worth $1,000 in a day, and then that you've done across 30 days, this is the amount of thing that you've collected. Basis the analysis of the spends that have happened by looking at the point of sale machine data or digital payments data, you will say that I'm going to lend you, if you've done say 10,000 worth of business in a month, you can say that I'm going to be lending you $15,000 or $20,000, right? Where are you getting that data from? The important point is the point of sale data or the digital payments data. And there are a lot of providers now who provide the point of sale machines and then have a separate subsidiary which lends to these merchants as well, right? And all of that is hinging on analyzing the data from the point of sale swipes, right? So that's one basis. Assessing the cash flow is one data point. The second data point obviously is, I mean, whether there's VAT returns that you file or GST returns that you file with consent of the merchant, right? You can actually pick data through API calls and see the kind of business that they're doing in a month or in a quarter or in a year. I mean, you can clearly make out that there are certain months where there is a peak. There are certain months where the business is low. You can also make out, say for example, at times, the goods are of not good quality. Maybe you want to return those goods, and there is a refund or a return that you need to give to the customer. So, what kind of refunds are you processing as well because of faulty goods or quality of goods which is not good? Right, a lot of that is also something that you can analyze from your GST or VAT returns that you do. The third one is really the whole supply chain financing on the marketplace, the e-marketplace, right? And I'll take an example here. If you really look at Amazon, right, it sits right in the middle, right? So it clearly sees the amount of business the SMEs or the merchants are doing on the Amazon platform. And at the same time, it also sees that as an individual or as a business, how much has somebody bought in a month or in a year or in a quarter, right? What has the experience been? What is the rating of the merchant, right? So it sits in the middle. It knows who is selling how much, who is buying how much, what are the returns that are happening, what is the feedback that the small merchants are getting, right? So all of that is something that comes as part of the supply chain. Now you use all of that data to really then analyze who is creditworthy, the merchants, really who is creditworthy, how much of credit they should be getting, right? All of that is something that you really look at when you're looking at cash flow based lending, right? So what I'm trying to say is that because of digital payments, point of sale, VAT and GST data, or just because of the e-marketplace, there's so much that lenders today or even e-com players have today, which then tie up with lenders to really arrive at lending not only to individuals but also to merchants and small and medium enterprises, which is purely based on cash flow. There is no underlying asset that actually gets mortgaged or hypothecated to the lender. So this again is on the cash flow based lending. So to summarize broadly, now we spoke about the NPL, the buy now pay later, then we spoke about the asset based financing, and then we spoke about the cash flow based lending. All of this again relevant both to individuals like you and me, or also to merchants and small and medium enterprises, because of the digital footprints that are getting created in this digital world. Thank you, and happy to answer any questions. Am I audible?
Yes, I can hear you, Mr. Nilesh. Ladies and gents, if you have any questions, we still got time. Okay, I guess no one has any questions. Thank you for the great workshop, Mr. Nalish. Our dear audience, thank you for supporting our event by attending. We hope you enjoyed the experience and received beneficial information. See you in our next workshop.